Hello, and thanks for joining us for the Max Financial Services Market Thursday's markets update call. We are doing it today on Friday. We had a scheduling conflict yesterday that prevented us from doing it, but also at the same time it worked out beautifully because this week was actually a pretty big week on the economic front. So let's get started. Pretty ugly day today, actually. The market was down the Dow was down about 367 points, which is over 2%. The S&P was down 36 points, which is 1.78%. This comes on the heels of a down day yesterday, broadly for most of the markets. But when we look at the entire week from Monday through Friday, we're only down about 0.8% on the Dow and only down 0.34 or 1/3% on the S&P 500. In reality, from Monday through Wednesday, we pretty much had pretty sizable gains. And then as soon as we had the Janet Yellen Fed rate hike decision, the markets have been selling off since then. It's going to be really interesting to see what happens in the future. Maybe we'll talk about that a little bit later on. Oil finished down at $34.60. This was down from last week at $35.62. So we are down a little bit. Once again, we had the big news that oil was at 6-year lows. I believe it was a Monday or Tuesday when we dipped into the 34.60 area, and then we bounced back up to over 36. But since then, we've actually dropped down as well. Gold finished the week pretty much flat at $1,064 per ounce. Silver had a positive week at 14.09 per ounce. We finished last week at 13.69, so we had a decent 40-cent gain for silver, which is not surprising considering that the markets were down significantly over the last couple of days. So causes fear. That means money going into gold and silver. The VIX, which is an indicator you might not be familiar with, the VIX, it's an indicator that measures the volatility in the stock market, also known as the fear indicator. The VIX finished at 2034. So you have a little bit of a heightened sense of, not going to say panic, but concern. Typically during boring markets, as we would call them, the VIX typically should be right around 13, 14. So the fact that we had a pickup in the VIX is good. Now, the good news about the VIX is that it's down from 24 that we've seen in the beginning of the week. The reason why is in the beginning of the week and end of last week, there's been serious concern about the health of certain banks and the health of energy companies. But once again, we'll talk about that a little bit later on. And people are basically starting to panic about their junk bonds, basically higher yielding bonds. As a result, a lot of those sold off, and the markets are getting a little bit more shaky. The one area of the market that really had a really good time was actually the bonds. So the 10-year bonds have finished the week at, the 10-year U.S. Treasury finished the week at a 2.20 yield, and the 30-year bond closed down to 2.91, which is actually lower. And it almost seems a little bit contradictory to the news that we had on Wednesday, which was the big news of the week, the big economic news for the week. The Federal Reserve raised rates by approximately 0.25%, and they signaled a gradual rise to the interest rates. Now, this has been the first Fed hike in, I believe, in over 8 or 9 years. And the joke of it was there's very few people at the Federal Reserve who were around for the last time they actually had to hike rates. There's actually a cartoon that came out. It was pretty funny, which basically showed, it's like, I think it was maybe the New Yorker magazine or one of the magazines, but basically there was a panicked Fed, and we're like, does anybody actually know how we increase interest rates? So a little bit interesting. What does it mean for the investment public? And the corporations? Borrowing rates in the short term, if you're borrowing money in LIBOR, that's going to increase a little bit. But it also means on your savings accounts, you might get a little bit a bump in interest rates. All in all, the Fed believes that the economy is on more stable ground. The fact that the headline unemployment rate is right around 5%, a little bit below 5%, which from all intents and purposes, signals that the economy is okay and it's normal to increase the rates. The reality of it is, even though they've raised rates in the short term, the longer term rates have actually started coming down. And one of the things to really kind of look forward to, and one of the key takeaways is, even though the Fed is increasing rates on the short term, the long term interest rates are coming down. What that's creating, it's creating a more of a flatter yield curve. And basically it means that it costs you the same to borrow money for a shorter period of time as it would for a longer period of time. Typically, a flat yield curve or an inverted yield curve where short-term rates are higher than long-term rates is going to signal that it's a sign that something's wrong with the economy. And for the most part, it leads to a recession. So it is one of the things that more people are going to be concerned about. Overall, once again, it was a very volatile week. People and the markets pretty much expected that the Fed was going to raise rates. If they weren't going to raise rates, it basically signaled that there's something truly wrong with the market, or there's something wrong with the economy, and the market was going to sell off. So really what we got was the best of both worlds, where the Fed did raise the interest rates, but they kind of signaled that any future interest rate raises are going to be gradual, and they're going to be looking at inflation quite a bit. As long as there's low inflation, there's less of a catalyst to raise interest rates, because typically if the economy is on fire and inflation is through the roof, one of the mechanisms the Federal Reserve has is they're going to increase interest rates to lower inflation. We don't see that happening. In fact, with the lower energy prices that we've been seeing, there's more of a pressure towards deflation rather than inflation. As noted, I mean, last time you filled up your gas tank, it probably cost you significantly less than it cost you before. On the earnings release side, so there's a couple of earnings releases that I paid attention to. Earlier this week, FedEx reported better than expected numbers. They beat both on the earnings per share basis, and they also had higher revenue than people expected. Granted, it wasn't their all-time high earnings, but typically you can look at FedEx as a benchmark for how the economy is doing as a whole. The question I have personally is, well, are their numbers, did they beat the expectations because the expectations were lowered? Or perhaps possibly because they're doing better than the competition. They might be taking a bigger piece of the pie, but if the pie is shrinking, then you got to take a look at the bigger picture. Or it truly might mean that the state of the economy is doing pretty well. Definitely as we get into the end of the year, people are going to be shipping significantly more packages, so we'll see how UPS and the rest of them cope with them. But actually, this really leads into an offshoot that I wasn't planning on talking about, which was Amazon is starting to launch their own, looking to launch their own airline. So one of Amazon's biggest problems is they ship so many packages that they rely completely on the United States Postal Service, they rely on UPS, they rely on FedEx in order to deliver the packages on time. And it's also one of their highest cost centers for the company. One of the things they've been actually playing with is out of Allentown, Pennsylvania, I believe, and actually out of Ohio. They started contracting with their own freight companies to fly packages between their distribution warehouses. Today, there is a report that Amazon is in talks with Boeing to lease 20 767 planes and look at going into this with going deeper into that pool. They're going to look to dive deeper and see how much they can actually offshoot that. Questions really arise. I mean, if it works, it could be really, really good for them because it has the potential to bring down costs. But what does Amazon know about running an airline? That's really the other question mark. So it can save them money, or it can cost them a significant amount of money. I guess we can even have a debate whether it's the same thing that what Google does with a lot of their ventures, where they throw a bowl of pasta against the wall to see what sticks. And if something works out for them, it works out for them. But Amazon's airline, I mean, granted, it's not for passengers or anything else like that. It's truly for them to control the cost of shipping packages either between warehouses or direct to other distributors at a lower price point than they would with FedEx or UPS. And once again, though, I mean, FedEx was the primary shipper for Amazon. Then it expanded to UPS. Then they started working closer with the post office, and a lot of places in the larger metropolitan areas, Amazon actually has their own people that deliver the packages themselves. So the question is this going to be something of a really good service that Amazon provides, and it's going to be a success, kind of like Amazon cloud services, or is it going to be the next Fire Phone? The problem is 20 Boeing 767s are going to be a little bit more costly than almost anything else is going to be there. But once again, if you're an investor in Amazon, that's one of the things you have to expect. They're going to invest a lot of money into the business with no guarantees whether it's going to work out or not. So Amazon, you might have the Amazon drones in your front yard, or you might have an Amazon 767 over your head. So we'll keep an eye out on it. The other big earnings release, and this is in full disclosure, this is a company that I personally invest in, BlackBerry. They beat earnings as the company is transforming. So they beat on an earnings per share basis, and they beat on the revenue perspective. BlackBerry is a really interesting investment. I follow it personally, and we can talk in depth. Once again, this is not a recommendation or a solicitation to invest in any of the companies mentioned. One of the reasons I personally like BlackBerry is for the security play. And BlackBerry is truly transforming themselves as a company that dealt only with devices to dealing with software. And what most people probably don't know is if you drive a Volvo or a BMW or even a newer Ford, BlackBerry's already in your car. They run the QNX system that most of the infotainment systems are based on. So we're going to be launching more initiatives in that arena going forward. Once again, those are actually the really good bright spots in an overall crappy week for the market. On a global macroeconomic front, so what's things that you should be aware of, but they may not necessarily be in your backyard. Today, Ukraine officially defaulted on a 3 billion Eurobond loan that was provided to them by Russia. Basically, Ukraine is demanding that Russia takes a haircut on their debt. Franklin Templeton owns, so to Ukraine, some of the biggest creditors are Franklin Templeton, which has about $7 billion. They lent $7 billion to Ukraine for the Eurobonds. They've accepted about a 20% of a haircut. Russia didn't want to do that. They've agreed on different terms. And once again, you still have the overall geopolitical issues between Russia and Ukraine. But in short, it constitutes a default. The snuff in the face to this is that the IMF, the International Monetary Fund, they've removed a covenant that basically says that, much like a creditor or if you're dealing with mortgages, if you lent money to somebody and they defaulted on it, you're not going to give them new loans. IMF had the same covenants to the countries that they lend to. However, in light of Ukraine defaulting on their bonds to Russia, IMF is removing those, so it's basically business as usual. Even though Ukraine has defaulted, IMF is still open to lending them more money. So it's going to be interesting to follow that and see what plays out. The other big thing that's still continuing is the fears over the energy debt prices. Energy companies are having a hard time. Obviously, low oil prices are here. The question is how long are they going to be here to stay, and what's going to be the next step? You still have some people who believe that oil prices can get up to over 80 or 100 over the next year or so. But in reality, it just doesn't add up. You have a significantly higher amount of production coming online from overseas and even domestically. And at the same time, we have lower demand numbers, be it from China or even our cars are getting significantly more efficient. Prices are more than likely here to stay. Yesterday, President Putin had a 3-hour Q&A session that he typically does at the end of the year. And one of the quotes that I got out of it, that was a pretty big takeaway, was quote unquote, $50 oil is excessively optimistic for 2016. So not even Russia believes that $50 oil is going to be the average for next year. More than likely, we'll probably see low to mid 30s. It's possible we may dip into the 20s. Once again, you're going to have significantly more production coming online from the Middle East. Then you have Saudis who are basically they're completely okay with dumping more cheap oil. And Russia is basically doing the exact same thing. And once again, the stronger dollar is hurting us. But if you're Russia, if you're Saudi Arabia, they sell oil in dollars and their costs are in rubles or in their own local currency. So by their currency getting weaker, they keep a cap on the costs and they're still selling oil for roughly around the same price net to their own economies that they've had before. The other thing that happened right around the same time, so Delta Airlines, they had their Investors Day presentation, and one takeaway I had from that is they expect for aviation fuel prices to drop down to approximately $1.45 per gallon for 2016. They expect they're going to finish the year this year with an average of $2.23 in 2015, and this was down from $2.87 in 2014. So Delta, who even has their own refinery, they expect prices to come down significantly in 2016. What does it mean? It means if you're investing in energy companies, you're more than likely should be expecting more pain coming in the end of this year or in the beginning of next year. It has potential to get worse. We've seen some parts of it earlier this week when Wells Fargo was down about 10%, if I'm not mistaken, during one day because Wells Fargo, it was reported that they owned a significant amount of bonds that they lent to energy companies. And as energy companies are going to have a harder time with lower oil prices, it means that there might be significantly more defaults. And as such, well, if there are going to be defaults, then if you're a junk bond holder, if you're an investor in high yield, there will be issues that are going to be coming to you. Overall, at the same time, like I said, we still believe that we'll see a flatter yield curve. Short-term rates will probably continue to increase to match up with what the Fed is trying to do by increasing short-term interest rates by about a quarter basis point, 25 basis points up to 0.25%, up to their target between 0.25 to 0.5%. And what's actually been happening over the last few days is long-term 10-year and 30-year bonds have actually been coming down. One of the reports I've seen earlier today is more and more traders, they're getting more panicked with what's happening in the corporate bond sector. They think that defaults are going to increase. So more people are dumping their money into U.S. Treasuries. And once again, U.S. Treasuries, I mean, 2.2% for a 10-year bond may seem high, but when compared to what you're getting in Europe, it's really, really good. So a lot of international money can still see opportunities by investing in U.S. dollar, in U.S. bonds and U.S. debt. Overall, I think 2016 is going to be a fairly tough year. We might see long-term interest rates come down even more, and then we might more than likely they'll probably have a recession 2016, end of 2016. So I guess that's one of my predictions, and I'll probably do that next week. We'll do 10 predictions for 2016 and as far as what we're going to see. So hopefully that was helpful. It was a little bit longer than 15 minutes we usually try to do, but we did have a pretty full week with plenty of things that needed to be discussed. Thank you as always for tuning in. Next Thursday, we will continue with this conversation, and stay tuned for more financial planning related videos that we're going to be doing, interviews, kind of like how we did 2 weeks ago. We spoke with an expert on refinancing your mortgages. We're going to be doing more with other financial planning topics such as buying a home, planning for college, and we're also going to be focusing on more investment related blabs such as how do you control the volatility in your portfolio, and what are some other type of investments that you can do. So thanks for joining us again. Once again, my name is Max with President Max Financial Services here in Princeton, New Jersey. Thank you. Take care.